Awesome. Let's get started.
All right. Hi, everybody. We are now live on Facebook. Welcome to the Monthly Market Insight. We'll be reflecting on kind of year to date through October. It's been October was a bit of a roller coaster, ending up on a high. Stocks actually performed the best they have all year last week. So we'll kind of go into some information on that. So Sean, if you want to kind of start us off with, people are starting to talk about taxes, planning for next year. I know a lot of companies are starting to send some information. So what should we know about increases in terms of contributions to retirement plans?
Yeah, so kind of most recently, the IRS released the updated numbers for 2024. And so those numbers have increased. So the IRA contribution limit for 2023 was $6,500. The IRS gives you a $1,000 catch-up if you're over the age of 50. Now that will change in 2024. The IRA limit will go from $6,500 up to $7,000 per year. And that also catch-up contribution remains the same. So no increase in the catch-up contribution for those over the age of 50, but the IRA contribution limit goes up by $500. And remember that IRA contribution can be split between a traditional and a Roth, but you can't put the maximum into both, right? So one or the other, or a total combination split between the two, is how the IRAs work. Now, for 401ks, the limit for 2023 was $22,500, and they gave a $7,500 catch-up contribution for those over the age of 50. That number increases by $500, just like the IRA, and goes up to $23,000 in 2024. The catch-up contribution remains the same at $7,500. So that is the amount that you can put in. And again, for 401ks, as the employee of a company, if you're a W-2 employee, you can only put that maximum contribution into one 401k. Again, if you have multiple W-2 jobs where you get multiple W-2s, then you can split that amongst the different ones. But ultimately, you can only put in that 22.5 for 2023 into any of your 401ks as the employee. Right. So those are kind of the key things to look out for. Some of our clients are airline pilots and fly in the military reserves, and we get that question a lot. The TSP, can I put 22.5 into both? The answer is no, right? That 22.5 has to be a combination between your airline job and the TSP or your 401k through the military. So depending on how your situation set up, that is an option. For self-employed business owners, you can still put in the employer part of it, which is 25% of your net income, and that goes on top of the 22,500 for 2023. So those contributions for 2023 have to be done by the time you file your taxes, right? For 2023, the tax filing deadlines can be April 15th. That's going to be Monday, April 15th of 2024. All of your contributions have to be updated, and your tax filing has to be complete, or else you'll have to file a tax extension. So those are trying to come the biggest numbers to be looking out for into 2023 and 2024 that will impact the most of my clients. And again, you kind of mentioned too, Nora, how are the markets moving? One of the big reasons that we saw the uptick there at the end of last week, really all asset classes performed pretty darn well. And that's because the unemployment number is ticking up. So on Friday, November 6th, the Fed announced, I should say the Bureau of Labor Statistics announced that the unemployment rate had climbed to 3.9%. The previous months, it was at 3.8, 3.7, and it was as low as 3.3 in April. Why is that important? Because the Fed raises the interest rates based on this unemployment number. When we go back and hear all of these news articles talking about a recession, really what they're looking at is, has the labor market increased its unemployment number by 0.5% over the previous 12 calendar months? So we're starting to get into that correction territory where we say, hey, when all of this started, we started talking recession, unemployment was around 3.7%, kind of a pullback in the beginning of the year, and now it's been slowly increasing. So the hope is that, hey, if those things are happening, and this is what the Fed is watching, maybe we won't get more interest rate hikes, or we won't get them as high or as long as we expected. And really, this is what's been moving the markets. Every time we get some of this information about unemployment numbers or inflation, then the markets move. So we've seen inflation kind of steadily come down. And then the last 2 months, it's remained at about 3.7%, right? So we get our next inflation report number on November 14th. So now we got kind of good news, if you will, according to interest rates, and that is unemployment is increasing, which seems counterintuitive, but that's what the Fed's trying to do by raising interest rates. We see unemployment increasing. Do we continue to see inflation decrease? If we get those two things in combination, we could say, you know what the Fed is doing in terms of raising interest rates is going to be good for the overall economy, and it's going to be good for kind of the interest rate environment. So those are the two big things that are coming. For the month of November, we already got the unemployment number, a slight increase from 3.8 to 3.9, an increase of 0.6 from our market low in April, and then we'll get our inflation report number. Again, we've seen 3.7 the last 2 months. We'd like to see that inflation come down below 3.7 on November 14th, and we'll continue to monitor that. I will tell you, when I go to the gas pump, I pay $2.97. So things like oil, we're starting to see things in our average day, which tend to be a leading indicator that says, you know what, maybe we are seeing some inflation trends decrease. Hopefully that remains the same. We'll find out on November 14th when we get that report. In terms of that inflation, you can kind of see we had 3.7 the last couple of months. In the beginning of 2021, we were as low as 1.4. That slowly increased throughout 2021. It peaked in June of 2022 at 9.1%. We've seen a slow and steady decrease over the last 16 months. And now we want to find out what happens here in November, which is ultimately October's number. Again, hoping for a decrease above 3.7. All of those things continue. Hopefully, we continue to get kind of the way that the market ended last week with steady increases. We saw the S&P 500 move by really over 1% per day over that time period, which is overall good, obviously. Now, the S&P peaked at 4766. That was our last peak, but that was on December 31st of 2021. So it's been a long time since we've seen the S&P peak. I'm pulling it up right now. It's currently at 4364. So we're still 400 points below our last market high, or still about 10% off of our last S&P 500 market high. So there's still a lot of room to go in terms of growth and reaching another market high. One thing that we always tell clients, and obviously past performance is not indicative of future results, but every time there's been a market high, 100% of the time, there's been another market high. So we saw that peak December 31st, 2021. Another one will happen. We feel confident in that. We just don't know when, and that's not a game we'll play. So a good opportunity to buy and get into the market while the market's discounted, trending in the right direction over the last week. We look at kind of how the markets have moved throughout 2023. In our red here, we've got our NASDAQ index that's in our portfolio. The black is going to be our S&P 500. The light blue is going to be our U.S. small value, and then our government treasury bonds are going to be there in purple. Bonds continue to decrease, and that's because interest rates continue to rise. As interest rates rise, we see bond prices fall. It's a known phenomenon. That's what hurt bonds so bad in 2022. As interest rates, or if I should say interest rates do fall, we should see bond prices start to increase again. But overall, people are getting a lot better yields. You're getting opportunities for high yield savings accounts in banks at 5%, CDs, treasury bonds, all paying more than 5%. So some very good, safe options to earn more than 5% of your money. And as that price comes down, or I should say the interest rates come down, we'll see those bond prices go up, and maybe some of those coupons come down moving forward. But generally speaking, kind of gives you a good snapshot of really technology, or that NASDAQ index has been pulling along the rest of the market. Everything else has kind of been going ho-hum, all right? A decent year, really. However, we still want things to pop. We're starting to see unemployment rise. We want to see more inflation decrease, and we should see the market continue to rise moving forward. Kind of some of the big trends. It has been hard, right? So our last market peak we saw was July 14th, right? That was kind of the last time we saw the market peak in 2023. It's been a steadily decline from July 14th of this year all the way through October. And then you can kind of see these slight upticks here based on the end of last week. So again, things trended up because of a good unemployment number. Things were doing well from the beginning of the year, really through that February timeframe. Things kind of pulled back. Then May through July, we saw another increase. July through October, we've seen some decreases. So a lot of up and downs, and a lot of it's been based off of what the Fed has been saying. In addition to that, throughout the year, one thing that's been constant is companies are out earning their analyst expectations for their earnings. So we continue to see a greater number than average of companies that are reporting more positive earnings or revenue than they were expected. So that in line with what's happening with unemployment and interest rates means companies still have really, really good growth. We would expect the market to be growing at a much higher pace than it is, given all that fundamental data. It's just some of this macroeconomic data in terms of interest rates and inflation and unemployment that's really been holding the market back. So we want those things continue in the right directions, companies continue to earn money, consumers continue to spend. Overall, the market, we believe, is stronger than it's showing really on its earnings for the year. One thing that has been hard, right, for people really since that peak of 2021, people are saying, it's been almost 2 years now since we've seen a peak. I'm kind of getting impatient. Right? We've seen some good options for safe money with CDs and treasury bonds and bonds in general. So good, safe opportunities there. That's been positive. But we want to be long-term investors. That's what we're doing. When we look at things over the long term, things are positive, right? So we see the NASDAQ index, we see our S&P 500 index, and we see kind of small value. All of those things tend to have increased over the long term. And that includes kind of the pullback of 2008. That includes the coronavirus recession. And that includes what's happened in 2022 with the rapid rising interest rates. If we stay invested for the long term, it's going to be the best thing for you, best thing for your portfolio. And the portfolio will earn money by reducing risk, owning thousands of different positions, diversified across the globe. So that's kind of a trend of what's going on in the market and some taxable things to be thinking about as we get into 2024 tax planning and as you start to prepare for 2023's tax filing. One thing we've been recommending for people is that it is a good time to buy into some of those IRAs. Trending into 2024, we'll also recommend to our clients something we did last year. The market's discounted. If you want to fund your IRA for 2024, it may be a good option to do it in one chunk at the beginning of the year rather than spreading it out through the year if you have that capability, just because we want to buy the market while it's discounted. So things we've been doing for clients is reaching out to them, wanting to do their backdoor Roth IRAs if their income's over that limit, making sure they get that amount into their IRA if they've forgotten about it, and then starting to plan for 2024, what opportunities are available, what's the best way to go ahead and fund some of those things. Again, a lot of companies pay out their bonuses at the beginning of the year from the previous year, a good opportunity to maybe super fund a 401k or an IRA. Again, really good options and things to think about for 2023, 2024 tax preparation as we prepare to meet with our clients for our fourth quarter and into first quarter tax planning and preparation.
Thanks, Sean. I know one other kind of topic as we're getting into planning for 2024, and we did it previous election, is we're about a year out, right? And you're going to start getting bombarded by a bunch of media and marketing. And we're starting to have some of these questions, or at least concerns, on should investors be worried about what the election brings next year? What kind of we say to that? I know we'll probably hone in on that as that approaches, but just to kind of get ahead of it as we get into next year.
Yeah, absolutely. And so we put out a great kind of presentation last election, and really it's calmed down. It doesn't matter what side of the aisle you're on. We use data, right? We're very data centric, right? We want to be very objective when we're looking at these things and not put our emotions into it. When you go back and look at the data, Democrat, Republican, president, the incumbent stays in, new president comes in, House and Congress, if it's a unilateral party or split between kind of the Senate and the House of Representatives, it doesn't seem to matter. There's no data to support one way or the other that one combination is better than the other. I know everyone has their strong opinions and emotions about that, but when we look at data, there are so many other factors that go into how does the market perform when someone's in office, that it doesn't really matter who's in office. If a war breaks out, if COVID breaks out, if a pandemic breaks out, there's so many different things that could happen that it doesn't really matter who's in office. And one thing that we always try to reiterate is companies are going to find a way to provide value to their shareholders because that's their objective. regardless of, their emotional status about the government, regardless of their party, regardless of what's happening in a geopolitical standpoint. High tensions across the globe. I feel like I could say that every 6 to 12 months. There's always seems to be something going on, and the markets continue to plug along. Sometimes we get so inundated with what's happening in the current news day cycle that we forget to stop and take a look back at how have the markets done since 2007, since 2000, since 1970, since 1927. We've gone through world wars, we've gone through conflicts all over the world, we've gone through pandemics, and the markets continue to produce. So as long as we're invested for the long term, the markets will continue to be there if we have a diversified low cost portfolio, which is our objective. And some of the things that are unique these days is there are some cash instruments in terms of CDs, money markets, treasury bonds, other sorts of bonds that can give you a really, really safe, consistent return that are becoming more of an option for people, much more so than prior, or since 2008, when the Federal Reserve lowered interest rate down to 0.25%. Now that it's up around 5.25%, there's unique opportunities there and some great things to do with your cash, which we can certainly help with.
Yeah, I appreciate it, Sean. Thank you, everybody, for jumping in. If you have any questions as we get through November into our next monthly market in December, please reach out. And with that, everybody enjoy the start of holiday season.
See you, everyone.